Holy smokes, the Federal Reserve is now printing as much money as they want. Forget $200 billion of stimulus or a few rounds of $80 billion. How about $1 trillion? Forget all of that. The Federal Reserve is now a Robinhood user taking advantage of unlimited leverage, or maybe just unlimited ink in their printing press. Basically, the Federal Reserve today at 8 a.m. Pacific Standard Time on March 23rd announced that there will be no limits to the amount of money they can print. Let's try to explain this to understand what's actually going on. When times get tough, a lot of us get nervous. We look at our investments, our stocks, our real estate, money we have in the bank, all as tools to help us feel more comfortable. Sometimes we even look at our credit cards and go, okay, well, I can borrow a little bit there if I need to, I can borrow a little bit there if I need to. That's not always the best case scenario, but we look at these sources of potential money to feel comfort, especially in very uncertain times, which is exactly what we're experiencing right now. Well, what if now you were feeling uncomfortable? I get it. Like, I feel weird too every day looking at the news. It's a scary time. And then somebody came up to your door and said, hey, how would you like to sign up for this credit card? There's no limit on that credit card, so any spending you need to do, no worries. And if for some reason, even though I'd really like you to pay me back, if for some reason you can't pay that credit card balance off, don't worry about it. It's a non-recourse credit card, so we're not gonna come after your house or your family minivan. Just feel comfortable right now, okay? Well, that's basically what the Federal Reserve did this morning. But wait a minute, where does that money come from? I mean, the money's gotta come from somewhere, right? All right, here we go. This is the Federal Reserve balance sheet, and right now, they don't have enough cash. So all we're gonna do is hop on into this spreadsheet. We'll zoom in a little bit, and let's just put in here, let's write in, let's delete that and put in $1 trillion. Let's see, million, billion, trillion. All right, we're in the green. See, most of the money that the Federal Reserve prints these days isn't actually printed. Most of it is just done electronically. But they do have to record that on both sides, so to speak, of the accounting equation. After all, it is called a balance sheet, which means two sides have to balance. You can't really have a balance with only one side. Anyway, that is the debt book. So we'll just go ahead and open that up, do a quick little note here. And there we go, Americans, we owe you $1 trillion more, the Fed. And the Fed's now essentially received authorization to do that as many times as they want, with absolutely no limit. So what the heck is the Fed gonna do with all that money, and how does that change my life? Well, the Fed basically goes shopping at this kind of nasty candy store called Healthy Food. So they go buy things like treasury bonds. Now, even though lately treasury bonds have been the Fed's favorite, they're also now opening their palette to money market accounts, to, what do we got over here? Looks like we've got corporate bonds, and then we've got some ETFs. And the Fed has also, to sort of inject more money into the world, gone on even more of a creative shopping spree, and now they're getting into shopping for student loans. And they're starting to even shop for credit cards now. And so much like you and me, we all like passive income. You know, money you make when you don't really have to do anything. You know, those dividends or getting interest on loans, like getting dividends from ETFs. We'll go ahead and put that in the box. Let's say we own some ETFs here. And we own some corporate bonds. Hey, you know what? That's some debt that's gonna pay us some dividends, I'm sure. Money market accounts, cool. Got some cash to work with, even though it's not FDIC insured. Student loans, yep, they pay a lot of interest. That's nice. Credit cards, ooh, those pay good money. I like those. And we'll get some treasury bonds. Those don't really pay a lot of money, but they're considered risk-free because, well, the Fed says they are, so why not? We'll go ahead and put that in there as well. And yeah, so now we have this box that's supposed to generate passive income for us, and we're a bank. The problem is, this is just a box of promises. If people don't pay their credit cards or their student loans, or corporations don't pay up, then this whole box isn't worth a lot. It's just a box of IOUs. And so that makes banks like this box kind of nervous, kind of start wondering like, oh, I don't know, do I really want to add some garbanzo beans to the mix right now? You know, I know John and Sally are working with Freddie and Fannie, and they're working on getting some home loans, which home loan might look a whole lot like this white Kit Kat here. And so even though right now John and Sally really want this home loan, and their real estate agent's gonna get paid when that loan gets made, the loan officer's gonna get paid, we'll get paid a little bit of money, the attorneys will get paid, lots of people are gonna get paid money when, you know, these people take out their home loan. But we don't know that we wanna add another IOU to our box right now. You know, our box is full of a lot of promises, and there's some scary things happening in the marketplace right now. Maybe we just tell them we don't wanna do this home loan anymore and give that Kit Kat back. That'd be really bad, right? I mean, now they wouldn't get their home loan, a lot of people would be without income, and you'd actually have something known as a credit crunch. This is when banks start getting nervous that there's not enough cash available at their company or at other companies, that they're worried that these corporations aren't gonna be able to pay up, or that people aren't gonna be able to pay their credit cards. They're worried that there's not gonna be enough cash around, so they start tightening and going, you know what? I got enough IOUs for now. I don't need any more IOUs, okay? Right now I need more cash, not more IOUs. And that's where the Federal Reserve comes in. See, when banks make a home loan, banks don't actually make money off the interest that John and Sally are paying on this home loan. They actually end up taking this home loan and putting it into a basket or a mortgage tranche full of a bunch of other home loans. See, we've got some black home loans, we've got some red home loans, and we've got some white home loans here. And they're all put together into this collection here. See, because big institutions don't like to discriminate. They don't like to be stuck with just one flavor. They want to be able to spread the risk, so to speak, to a bunch of other home loans. So they put these things together into a mortgage tranche, zip it up, and then they create something called a mortgage-backed security. A mortgage-backed security is created from this bundle. Basically, the bank comes around and says, all right, well, we know somebody's not gonna buy this whole bundle. And before anybody buys it, we're gonna have to grade it. So in this case, let's go ahead and call this one AAA rated. We haven't really looked inside, but we're pretty sure they're good. So we'll just call them AAA. This AAA rating should really help us sell these. And then we're gonna go ahead and just take slices of these mortgage-backed securities and go ahead and try to sell them to people. So we'll try to sell that, we'll try to sell that. Oh, and here's one, let's go ahead and take this. Okay, we're gonna sell this. This is a slice of all that debt right there. And we wanna sell this to get cash. Because remember, the bank does all these mortgages, but they want fees for doing the home loans. They don't really care about the interest, they want the fees. And they don't want right now more stuff in the box. They want cash so they can keep making money. So they go around saying, hey, we got a AAA rated mortgage-backed security here. Who wants it? And when other banks are going, good right now, yeah, I got enough IOUs. The last thing I need is a bundle of your AAA rated IOUs. You know, keep that in your box. I don't want it from your box. I got enough of my own AAA rated stuff right here. And that's where the Fed comes in. Well, bank, we'll buy your crap. You know what? Instead of just selling us your AAA rated bonds, why don't you just give us your whole box? Which is exactly what the Fed is doing now. The Fed's now said, you know what, instead of just buying treasury bonds and AAA rated mortgage-backed securities from you, why don't we just go ahead and also support and backstop your money market funds because you guys broke the buck. By the way, in case you want to learn how to actually master your money rather than just dumping out all the assets you have and doing a fire sale at the garage sale Saturday morning, you might consider investing in yourself and spending your quarantine days educating yourself on real estate investing, do-it-yourself property management, or rental renovations. Heck, learn the psychology of money or sales and learn a different perspective. Take advantage advantage of the coupon code down below. Make sure at the same time you also click that Webull link and deposit $100 with the stock trading platform Webull, because they're going to give you 2 free stocks valued up to $1,400. And do take advantage of that coupon code, because as soon as my designer sends me the new designs, we are making some changes to the program. AKA, I have to because it's scheduled and I said it, the price is going up. Which, just so you know, breaking the buck in a money market fund is kind of like the bank saying, hey, you got $5,000 in your savings account. Oh crap, but we only have $4,900 to back that up, so hopefully you don't come asking for it. Yeah, that's happening in money market funds right now, and the Fed's like, don't worry, we'll backstop you. It's all good. So we'll take your money market funds, and you know what? We're gonna do that to corporate bonds too. And we got credit cards here, we got student loans, we got ETFs, and I'm not even sure what this one is, but you know what? We'll backstop that one too. And we're gonna do this in an unlimited fashion. What I just described for you and showed with examples is exactly what's happening in the marketplace right now. Companies, corporations, businesses, and people are all desperate for cash right now. That's leaving a lot of people looking for help for short-term loans, short-term credit card financing, short-term loans by refinancing, and then, I'll pay that back, let me just refinance my house, I need money. Everybody needs cash right now because everybody's nervous. This, when people get nervous, is usually what creates something known as a run. A run can be a few different things. You could have a run on the stock market, a run on the bond market, or, which you may have heard of before, a run on the banks. A run is essentially when people literally just dump whatever they have just to be able to create cash. It's literally like taking your box of IOUs as a bank and going, oh crap, nobody wants to buy any of this crap. Let's just sell it at a loss. That kind of panic is exactly why we're seeing massive stock market declines at the same time as we're seeing weird things happen. That rarely happens, where things like bond ETFs are selling for less than they're worth. Money market accounts, which are supposed to be really safe, are selling for less than they're worth. And we're in such a state of uncertainty that if credit markets freeze up, the entire economy might seize up more than it already has. It's really, really bad. And part of the reason it's so bad is because there's so much uncertainty. When people are uncertain, they go to cash. When senators are uncertain and they hear about uncertainty weeks before all of us do, they sell all their stocks for millions of dollars in profits and they go to cash. And this is exactly why you get the Federal Reserve that comes in and says, "Fear not, we will protect everything." In fact, the Treasury Secretary is now even thinking about coming out with options and loans, which totally makes sense, I get it. But for small businesses, basically saying, hey, here, we're gonna give you loans, and this is part of the stimulus that's still being debated. We'll give you loans so that you can keep paying your employees, and if you can't pay it back, don't worry about it. And the Fed is basically ensuring all of this by saying, no problem, we'll pick up all these loans. No recourse, can't get your minivan in your house if you don't pay us back? No problem, no problem. Give it all to us. You know what? We have decided we want the biggest box of debt ever, because we could just keep creating more and more money. And if all of a sudden that $1 trillion isn't enough anymore, they could just pop on in and go, let's make that a 2. All right, it's getting orange. Let's just quickly update our other side of the balance sheet. Okay, we owe you 1 T more. Okay, but it's still yellowish orange here. I'd really like this to be green. Let's just, you know what? We've got infinite money now, so let's just make it $10 trillion of stimulus. Enter. Hey, we're green. All right, 10T plus. All right, who wants to go to lunch? While this is a massive simplification of how the Federal Reserve works, this is really, really scary. When the Fed is able to go on a spreadsheet and create out of thin air as much money as they want to saddle Americans with more debt, just to give banks the liquidity and cash they think they need because everybody's panicking, you know things aren't doing too well right now. Now look, what does this mean for our investments? What does this mean for stocks and real estate? And, you know, should we even bother investing right now, or should we be going cash as well? Well, actually, this is probably the right move at the moment. Even though there's this massive moral hazard that exists where companies can kind of just basically borrow money and pretty much not pay them back, this does give the market at least some confidence. And confidence right now, in a time of extreme uncertainty, is really needed. The theory is that in bad and uncertain times, the Fed goes into debt. The country basically goes into debt. And when times are good, this debt gets paid off. And eventually we can sort of tear the sheet off and say, hey, that one's paid off. Let's go on to the next one. The problem is the last time the Fed said, hey, let's start paying off our debt in 2018, they almost crashed the market. So we're in really unprecedented times. Even though it's crazy and it's hard to fully understand, it does give me some more confidence at least, and it makes me feel good about still being invested and doing real estate and investing in real estate because I know the banks are still going to have money. It does feel weird about what this means for the future, and like, does this mean my kids are gonna have to pay for all this debt? Like, where's this all coming from? Or are we just gonna go into the roaring 20s after this is all over and the machine's gonna work so well that we're gonna be able to pay all this debt off? I have no idea. All I know is that I really hope you follow me on Instagram. I hope this helped you out. And if you still don't understand the Federal Reserve, that's okay. Neither do I.